Good morning, ladies and gentlemen. Welcome to the program, Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and on this program, we're going to talk about the latest win for the insurance lobby. Aren't you happy about that? I mean, after all, we want the insurance lobby to just run rampant in Washington. And once again, they've done a good job on spending their lobbying dollars. So stay tuned on that, along with the fact that we'll give you the latest trends with the IRS and its audits. Something that everybody across America fears is an audit from the IRS. We're going to give you some interesting stats of late that reflect a changing IRS. IRS funding down almost a third over the course of the past 10 years. As you might well expect, there's a corollary to that, and the audits that are taking place and the types of audits that are taking place. Plus, we'll talk about whether you are confronting a higher amount of Medicare cost and what you can do to try and avoid that. It seems like every year at the beginning of the year, we get calls at the office that says, Joel, my Social Security went down. Why would my Social Security, after all these years, why would my Social Security go down? And then we have to explain, well, it's not because your Social Security went down. It's because the cost of your Medicare went up. So we're going to talk about why that happens, how that happens, and most importantly, how you can avoid that. So all that and more on the program. Let's begin with topic number one. So if you are a regular listener to the program, you know that we talked at length several weeks ago about the latest legislation coming out of Washington called the Secure Act. And most of the mainstream media really focused on a couple of the changes that the Secure Act would put into play, namely increasing the age of your required minimum distribution to age 72. So that's good because that means you don't have to take out your required minimum distribution for another couple of years beyond what the rules are now. However, what the good folks in Washington giveth, they taketh away with the other hand. And what they were taking away was the ability for beneficiaries of retirement accounts to be able to stretch out the payments out of those retirement accounts over the course of their lifetime. That's the concept called the Stretch IRA. And basically, what the Secure Act did was it eliminated that and said the longest you can stretch that out is over a 10-year period of time. Well, this legislation passed overwhelmingly in the House and ultimately is now stalled. It has not passed the Senate, but it did pass via vote of 471 to 3. So definitely bipartisan support on this particular piece of legislation. Moving the RMD age, obviously, that's a reflection of the fact that people are living longer. Unfortunately, eliminating the Stretch IRA is not something that many people, I think, focus on because you haven't had that wealth transfer happen that consists predominantly of retirement accounts. That generation that has a lot of their assets in retirement accounts is just beginning to kind of pass away. And so you don't really have a huge amount of that happening yet, but it certainly will be happening a whole lot over the course of the next 20 years as the baby boom generation passes away. A lot of their assets are in retirement assets. So it's one of those things where I think they're sneaking it in. Most people think, this probably doesn't really apply to me. It doesn't really matter. The reality is the Stretch IRA is perhaps one of the most powerful estate planning, tax planning, and retirement planning vehicles available so that when you inherit an IRA, you can spread that out over the course of the rest of your lifetime. Unfortunately, they're looking at revenue in Washington, seeing it running maybe a little bit short. That's probably more related to the fact that they're overspending, but, hey, who are we to judge? The reality is that they see that as a way to raise money. So that's the crux of the Secure Act. Here's the kicker. the insurance lobby engaged in a systematic lobbying approach to add one more little wrinkle into the Secure Act. Don't you love these names that the folks in Washington come up with for these bills? And the one thing that the insurance lobby added to the Secure Act was the ability to now start to use more of an annuity approach with a 401k. Don't you just love the insurance lobby? A lot of money in the insurance lobby, and they are lobbying hard in Washington to make their products more available to you, because the reality is that annuity products can't stand on their own because they're perhaps the worst type of investment product that an investor can own. Very restrictive, very high cost, and did I mention their incredibly high commission, which is why the financial services industry loves them that much? But the insurance lobby, man, they got a powerful lobby. So with the Secure Act, they push this notion of annuities, making sure that annuities become an option throughout the 401k land. Well, now they're looking at one other thing. And there's another thing in the insurance industry that can't stand on its own. Witness the fact that over the course of the past 10 years, there has been a tenfold decrease in this type of insurance. And the type of insurance that we're talking about is long-term care insurance. Between the past 10 years, the reality is that the number of long-term care sales, long-term care insurance sales, have fallen more than tenfold. Why? Well, because the reality is that the product is not a very good product. It's not like those long-term care policies that were issued like 15, 20 years ago that were the Cadillac of policies. But at the end of the day, when the insurance company's now starting to pay out on those policies, they're paying out a whole lot more than what they collected in premium. Some of those policies back in that time period were lifetime policies, meaning that they paid out over the course of your lifetime. There was no limit. There was no term on the payment of those policies. So obviously, if you go into a nursing home at 85 and have a bad case of Alzheimer's and live to 100, they're going to have to keep paying that over 15 years. Well, guess what? Those policies basically came close to bankrupting the insurance industry. And in fact, largely the reason why General Electric got kicked out of the Dow is because it had so many of those policies that just the fundamental economics didn't work. So the tenfold decrease in long-term care policies obviously has the insurance industry worried. So what do? They go ahead and they lobby the folks in Washington to help them sell more long-term care insurance policies. How did they do this? Well, this is the latest proposal, and it is from a Republican, Patrick Toomey out of Pennsylvania, that is sponsoring this legislation. And what it says is that you can take $2,000 out of your 401k, out of your IRA, pay no taxes, pay no penalty, and as long as you use it to pay a long-term care premium, then there's no taxes, no penalty, and you're good to go, no matter how old you are. Stop and think about that for just a second. What other example exists in the tax code that allows you to use your retirement dollars at any point in time with no penalty and no taxes? Isn't the insurance lobby just unbelievable? Unbelievable. We're going to have a few final thoughts on this when we get back from this break. So stay with us during the break. When we come back, we'll finish the conversation on the latest coup by the insurance lobby. Man, I don't know about you, but I'm getting a little tired about the lobbyists running Washington, aren't you? We'll be back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, here on News Radio, WFLA, Orlando. That's where we are with the Fresh program at 9 a.m. on Sunday mornings. For the rest of the world and for the rest of the viewing audience, we're available throughout all the different social media channels, whether it be your YouTube channel, whereby you can look at the actual video of me doing the program. Today, I am dressed a little bit more casually than normal, be it the Thanksgiving kind of break weekend type of thing. Hope your Thanksgiving was a pleasurable one, and the conversation of politics and religion did not rear its ugly heads during the course of your Thanksgiving meal with your family. So hopefully it was all just smooth as silk. I'm sure it was. And the good news is that memories being what they are, we only remember the good parts anyway. So we hope that your Thanksgiving was good no matter what. And of course, this weekend is a big shopping weekend, Black Friday, and then Cyber Monday, all of that on tap. But of course, if you're listening to the program on our social media channels, folks, places like YouTube, where we've got the video, and then, of course, Facebook, and all the different podcast channels, iTunes, Google Play, Google Podcasts. There's a ton of them, SoundCloud. The list goes on and on. We're basically on all of them. And so if you'd like to connect with us and catch the show, either in a video or audio format, the options are nearly limitless. Just go to our website, nelsonfinancialplanning.com. Click on any of the little icons that appear up at the top, whatever one looks most familiar to you. Click on it, and it will redirect you to the program. So before the break, we were talking a little bit about the latest coup by the insurance industry. So I want to set the stage about the bill that is now pending in Washington, courtesy of a Republican senator out of Pennsylvania, introduced it on behalf of the insurance lobby. And what it says is, it says that you can take $2,000 per year with no taxes, no penalty. By the way, that $2,000 is also indexed for inflation, so every year it keeps going up a little bit. And as long as you use that to pay a long-term care insurance policy, you will never have to worry about the taxes or the 10% penalty on it. Isn't that really amazing? Here's what the insurance lobby says, and I'm going to read it. This is from Jesse Sloan. He's the executive director of the American Association for Long-Term Care Insurance, i.e., lobbying trade group for long-term care insurance. The market for long-term care insurance is rather narrow and defined. Well, right, because the sales of long-term care have gone down by a factor of tenfold over the course of the past decade. Why? Because the premiums are super high and the benefits aren't nearly as good as what they used to be. Sorry, but the product isn't as good as it used to be. So guess what? People don't buy it as much. Very simple. The executive director of the Trade Association for Long-Term Care Insurance continues. But this bill is a great thing because it will help encourage the expansion of people who buy it. You know another way of saying that? It basically expands our base of customers because nobody's buying our product because it's not as good as of a product as it used to be. It's much more expensive. It's much more limited. So what should we do? Well, we should go to Washington and lobby them to pass a bill that creates an exception to any of the retirement rules that exist out there, whereby not only do you avoid the 10% penalty, because certainly there's a lot of exceptions for that, but you also avoid the taxes on it? Really? Wow. That's some powerful lobby, and that is a baseline effort to try and get more clients, more people to buy your product when your product itself does not stand on its own 2 feet enough. I think the insurance lobby needs to have its knees cut out from under it because it is way too powerful to be introducing legislation like this on a regular basis. This is 2 for 2. Secure Act introducing annuities, pushing annuities into the 401k workplace. Unbelievable. This one, hey, let's figure out how we can sell more long-term care policy because sales are down tenfold. Hey, let's expand the target market and give everybody the option to take money out of their retirement without having to pay any taxes, so long as it goes to pay an insurance policy for long-term care. I don't know about you, but if you haven't realized that, I got a little problem with that power of the insurance lobby. And I think that's an unnecessary change in the law that is being talked about in Washington. Not law yet, may not ever get there, but we just want to put it on the table and make you aware of it, that stuff is happening out there on a regular basis. Speaking of things that happen out there on a regular basis, are you paying too much for Medicare? Or are you paying more for Medicare than you ever realized that you were going to? We all know the cost of Medicare today. The cost of Medicare comes in at $144.60. That's your Part B premium. But a lot of people, about 1 in 10, don't pay that. They pay much more than that. And often when that happens, the question that we get is, well, why did my Social Security decrease? Because I'm getting less Social Security. And the reality is your Social Security didn't decrease. It's that your cost of your Medicare increases. And so what's happening there is there are different income levels that exist that once you get even $1 over them, then your Medicare premium is going to jump up. So there's some cliffs, if you will, to the income levels that trigger a much higher amount of cost for your Medicare Part B premium, and similarly for your Part D prescription plan as well. So if, for example, you are a married couple and your income, remember, it's income, adjusted gross income, your income goes above $174,000, then your Medicare premium for both of you is going to jump by over $58 a month, and your Medicare Part D surcharge is going to be an extra $12 a month. So that's a total of $70 a month times 2. That's $140 times 12. Help me with the math on that. That's about $1,700 more that you're going to have to pay if you are $1 over the threshold. Again, $174,000 if you are married, and $87,000 if you are single. As the income goes up, so too does what you pay for that Medicare premium. Medicare premium Part B, in fact, at the highest income levels, can be $491.60 a month, a total of almost $350 more per month per person. So double that if it's 2 people, plus a Part D surcharge of $76 per person. So double that if it's 2 people. So there are definitely some cliffs of income, meaning once you cross these thresholds, then you automatically have to have and pay a higher amount for your Medicare. So what can you do to avoid that? Well, here's where it gets pretty important, because obviously we're at the end of the year and there's still some things that a lot of people will see happen on their investment side that ultimately could drive their income above one of these thresholds. Things like your required minimum distribution, things like dividends and capital gain distributions. All of those types of things can go towards increasing that total income. Because remember, this notion of paying more for Medicare is purely based upon your adjusted gross income, not your taxable income. So what happens there is that you've got to look at tricks to adjust your adjusted gross income. And for that, we'll talk about it at length in our next segment. So stay tuned through the break. And we come back, we'll talk about ways that you can avoid these higher Medicare costs and how you can ultimately get to the point where if you're lowering your income by just a little bit, you're able to avoid the higher cost of Medicare. So stay tuned for that. We'll talk about that when we get back here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning, here on News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. We're talking a little bit about on the program today about Medicare and are you paying more than the normal amount for Medicare? About 1 in 10 folks out there are doing that, and that comes about as a result of legislation that actually goes back to 2003 that introduced this notion of the more money you make on your tax return, then you have to pay a higher surcharge on the amount of your Medicare Part B premium along with your Part D prescription drug plan. So depending upon how much income you make, you may find that instead of paying the $144.60 for your Medicare Part B, you may in fact be paying as much as $491.60 per person for your Medicare. So that legislation was introduced in 2003. The reason that it's picking up more and more people is that it was never indexed to inflation. So as the income goes up and the normal cost of living increases happen, whether it's on your Social Security or maybe you've got a pension or what have you, then what happens is that more and more people are in fact getting picked up by that. So between now and the end of the year, it's very important that you look at your income and make sure you are not tripping over those thresholds. Remember, the thresholds are determined based upon your total income, not your taxable income. Your taxable income is what your income becomes after you do your deductions or your standard deduction or your itemized deduction. So you've got to look at your total income. So what that means is then you've got to be aware of how much dividends and capital gains are coming in, what's your required minimum distribution, things like that typically happen at the end of the year. So here's some tricks that you can do between now and the end of the year to try and avoid that. Number one, something we've talked about a lot on the program, we think it's one of the most valuable alternatives to avoiding income from your required minimum distribution, and that is doing a qualified charitable distribution, a QCD, which basically means that you have a contribution go directly to your charity of your choice, directly from your IRA, not through you. It won't work that way. It's got to go directly from the IRA to the charity, and that ultimately allows that amount of income to not appear as part of your adjusted gross income. Far more powerful than taking the money and then trying to get a write-off or a deduction for the charitable contribution, because the deduction doesn't kick in until after the AGI, adjusted gross income, has been determined. So that won't help you. That traditional approach won't help you if you're trying to avoid these higher costs on Medicare. So it's got to be a QCD in order to reduce income. At the same point in time, if you are working, then contributing to a 401k through your employer on a pre-tax basis is a great way to reduce income to get you below the thresholds. If you're under age 70 and you're eligible to contribute to a traditional IRA, then that also is a great feature to be able to take that approach so that you can take a tax deduction for that IRA contribution. And again, thereby lower your adjusted gross income. So if you're approaching those limits, you want to look at trying to more fully fund on a pre-tax basis or on a traditional IRA basis. One of the many places where getting that tax deduction, doing things on a pre-tax basis, really do help in ways that are more than just the tax savings, particularly with respect to this cliff and how much more you could potentially pay for Medicare. So make sure that you pay attention to funding that 401k or that IRA if you are eligible to do so to help bring down that income. On the flip side, if you're looking to draw income out and you're approaching one of these thresholds or these cliffs that would increase your Medicare, then what you've got to do is you've got to make sure that if you need money, you're taking it from places that aren't going to generate taxable income. So maybe that's an after-tax account where you've got some basis in that investment, and that basis, of course, comes back to you without any taxes. Or it's a Roth where you're taking money out of on a Roth, or even an HSA. Again, places that you can go to use money that are not going to increase your overall income, because what you certainly want to do is to make sure that you're not anywhere close to these thresholds. Because if you go $1 over, then it's going to cost you, starting at about $58 more per month per person, and the numbers go up from there. So be careful of this, particularly as you get to the end of the year. Make sure that you're being aware of what your dividends, capital gains are. Maybe if you've got some capital losses somewhere in your investment portfolio on an after-tax account, then you would take advantage of that and convert those paper losses to a realized tax loss so that you can get some savings so you don't run afoul of these cliffs as it relates to Medicare. So certainly some important stuff on that. Now, if you get hit with it, you can try an appeal. And the appeal process is a form SSA-44. And your best argument, at least based upon the data, your best argument is to argue that there has been a life event, a divorce, a marriage, a retirement. Those types of life events that are permanent in nature stand a higher likelihood of you being able to make a change or to argue for a difference in terms of what this Medicare cost would be. A one-time event that increased your income, like a sale of a stock or a sale of a business or a sale of property, that's not going to fly. It's got to be a life event that yields a permanent change is really kind of the only way you're going to argue to be able to avoid it. Otherwise, the increase in cost for Medicare is, in fact, a black and white type of analysis. If you're over by $1, then the higher premiums going to apply. So make sure you're paying attention to your income and watching that to make sure that that does not cause any issue at all. Because after all, healthcare, one of the biggest expenses that you'll spend in retirement. As a matter of fact, based upon the latest study out of JP Morgan Chase, healthcare costs, not just insurance, but out-of-pocket healthcare costs have tripled or will triple over the course of a normal retirement. For a 65-year-old, the normal out-of-pocket cost comes to about $5,200. By the time you are 85, those out-of-pocket costs will be the equivalent of $18,000. That's a huge amount of out-of-pocket. Setting aside how much you're paying for Medicare, out-of-pocket costs, $5,200 at age 65, typically will grow to about $18,000 by the time you're 85. Why? Well, it's 20 years, it's inflation, and unfortunately, as it relates to healthcare costs are not going up at a mere 2%. They're going up at about 6.5% per year every year. So what can you do? Well, just like with these cliff levels for income that trigger higher Medicare premiums, the same thing is true for being able to cover your higher out-of-pocket costs that are going to occur during the course of retirement is you've got to plan for it. You've got to have it in there as part of your overall retirement picture, a line item that says medical insurance and healthcare costs out of pocket, because those two have to be a part of your retirement plan, and you've got to have those healthcare costs in there as part of your overall picture, particularly when they increase at 6.5% per year. That's a pretty significant increase, but unfortunately, that's the historical trend. So you've got to have it in there and understand that the number that you're paying out of pocket at 65 is going to be a whole lot more at 85. So be careful of that. Make sure you've planned accordingly. Speaking of planning accordingly, next segment, we'll talk about the latest trends from the IRS. So stay tuned for that. We've got a lot to share on that segment. Coming up next here on Dollars and Cents, this is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Howdy, friends. Joel Garris, Nelson Financial Planning. You're listening to Dollars and Cents. On this segment of the program, we're going to talk about the latest trends in the audit machine that is the Internal Revenue Service, perhaps the most feared institution in our government, the IRS. Nothing's worse than getting a letter from the IRS. But there's been some interesting trends of late, particularly over the course of the past 10 years, and we thought it would be neat to share them with you, our listening audience. Perhaps the biggest thing that has happened is that there's a lot less dollars going to the IRS on a funding basis. If you look at their funding over the course of the past 8 years, there's been almost a third drop, a 28% drop in the amount of dollars that they get allocated to them. Well, as you might well imagine, what's the net result of that? Well, there's less audits. And if you look at the number of audits that happened 8 years ago versus today, you're looking at almost a 50% drop in audits. And that sort of makes sense because the reality is that they just don't have the money. And so consequently, the number of audits have been on the decline. But there's been some other trends that sort of offset that. And we wanted to kind of share with you those trends just to give you some perspective in terms of how the IRS still works. Because at the end of the day, even though they might be auditing less, there's other things that they're doing a lot more that have a much more powerful tax consequence and cost consequence for you. So most of their audits now are done by mail. That's number one. 3 out of 4 audits done by the IRS are mail. You will get a letter in the mail that says, hey, we think there's something wrong with your return, and it's ABCD, and would you like to respond? Shockingly, nearly 2/3 of those letters go without response, completely unanswered. So you know what happens then, right? If you don't respond to a letter from the IRS, well, they say, no problem. You owe whatever it is that we believe that you owe, period. End of story. Default judgment goes in, and guess what? You owe all of that money. So first and foremost here, folks, if you get a letter from the IRS, I'm going to be bold and say, you got to look at it, you got to read it, and you got to respond to it. Go talk to a tax professional on that and ultimately get some guidance as to how best to deal with the IRS when you get a letter. When you get a letter, more often than not, it's usually a mismatch of computer information. Most of the letters that we help our clients deal with at the office are the disconnect of information that was sent to the IRS. Because remember, a lot of the tax documents that you get a copy, but the IRS also gets a copy. And so what they're doing is they're using their computers to sort of match that stuff up. And what happens is then that notice gets generated out so that you wind up having to answer to what is a discrepancy of information. So usually those are relatively easily solved or easily explained. Maybe you forgot about a particular tax document on your tax return, or maybe the IRS doesn't have all of the information in terms of what actually appeared on your tax return. So it's so important that if you do get that audit letter by mail, which is more often than not what's going to happen, that you actually respond. It's shocking that nearly 2/3 of those letters do not get a response. On a side note, here's one of the things that you will not get. The IRS will not call you. The IRS will not call you and say you're about ready to go to jail unless you wire money to some ridiculous account. And I know throughout Central Florida, particularly at tax time, folks get those calls. Folks, those are scam calls. Those are fraud calls. Those are criminals on the other end of the line that are just trying to take your money. So be careful of those. If you get correspondence from the IRS, it's going to come in the mail. It's not them picking up the phone. They're not going to threaten you to go to jail if you don't do it in the next hour. So do not fall prey to those scams. But make sure you open up the letter and make sure you respond to it. Because that letter most commonly is something called a CP 2000 notice, which again is just sort of matching up information. So a CP 2000 notice is not necessarily known officially as an audit, but it is basically what we were talking about earlier, which is where the IRS is simply trying to match information up. The IRS is pretty good when they send out these letters. They sort of know, okay, wait a minute, this return does not look accurate. We're going to send out a letter, or at least the computers know. Because 89% of the time, they're right, which means that 11% of the time, they're wrong, but 89% is a pretty good success rate. So if you get a letter, you better want to read it and just see if perhaps maybe there's a way to reduce down what they're saying that they owe. As you might well imagine, though, one of the trends is that if audits as a whole have gone down, audits, particularly for those that are most targeted or most likely to be targeted, have gone down as well. So for the wealthy, income over $1 million, back 7 years ago, 1 in 8 of those returns were audited. Today, that's 1 in 31. The most common type of audit doesn't have to do with people making $1 million. It's actually people trying to claim the earned income tax credit, which is something that's available on a low-income basis, but it's a pretty significant tax credit that allows you to get back thousands of dollars on your tax return. So a lot of the audits have to deal with that earned income tax credit because it does get back more money than what you actually put into the tax system. So a lot of the audits will focus on that. The least likely type of return to face an audit is actually an S Corp or a partnership. If you've got an S Corp or a partnership, the chances of that getting audited based upon the numbers for 2018, 1 in 455. Part of that is because the IRS is facing a slew of its older agents retiring and not able to replace them with folks with experience coming behind. So they're just not able to keep up with the complexity. And of course, the world knows that. So as that audit rate has gone down, what's happened on the S Corp side of things? Well, the number of S Corps has surged by over 38% since 2005. See the correlation there? Everybody kind of goes to, whoop, they're not here, so we're going to go over here. And certainly that is the case in terms of the entities that are getting set up. So what has changed? What are they doing differently? Well, there's been a tenfold increase on the frequency with which they will punitively punish you through an accuracy penalty. And what that is the IRS saying, hey, you're a dummy. You should have known how to do this right. And because of that, we're going to penalize you more than what you actually owe. We're going to give you an accuracy penalty and hit you with that. And that has been the mechanism with which they've used to try and continue to raise as much money. Now, granted, they're not doing as many audits, so how are they still able to kind of still generate a good amount of revenue for the U.S. Treasury? Well, they're doing that through a tenfold increase in the accuracy penalty. So bottom line, if you're doing your taxes, you're thinking about your taxes, look, the reality is the chances of an audit are much less, particularly a face-to-face one. More often than not, it's going to be a mail, a letter, not a call, but a letter. Now, if you get a letter, please open it up and respond to it. Don't just roll over and let them do whatever they want. Actually read the letter. Actually go talk to somebody and see if there's a reasonable explanation behind why their computer information didn't necessarily match up with what you reported on your tax return. Because more often than not, that letter is based upon the computer information. And then beware, because if you're wrong, they're far more likely to hit you with an accuracy penalty than ever before. And that is where the audit's going to hurt. So some important things to remember, some important trends as it relates to IRS audits and how they actually play out in today's world. So I hope you found that interesting, or maybe not, depending upon if you're in the middle of an IRS audit. The reality is that you certainly want to pay attention to what you're doing when it comes to your taxes. That's for sure. Anyway, we will wrap it on up and get on out of here. Thank you very much for listening to the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.